Welcome to today's video. Today we'll be talking about market trend identification and how you can properly make use of it to make money from the markets. It doesn't matter the type of market you trade, be it forex, cryptos, indices or stocks. As far as you're able to identify these market trends and make proper use of it, you're always going to make money from the market. So stick around as we dive deep to the video. Master trend identification and use. So in this video, we're going to be covering the following. Why do we study market trends? The basic terms you must understand in order for the video to keep flowing. The types of trends, then trend identification, and finally, the use of trends in the markets. Now, in terms of the basic terms, you must understand the following. What a swing in the market means. The swing high, a swing low, and what a break in market structure stands for. So don't worry, we're going to explain all these things in detail before diving into the trend proper. So firstly, what is a swing? Now a swing simply means a move in the price. Let this line represent a move in price, and of course you can see an arrow pointed upwards, so it means a move in price to the upward direction. You can say that this is the low of this particular line, which is the low of the swing, and this is a high of this swing. So this simply means a move in price, and this is what we call a swing in the market. You can see another market going down. You can say that this is the high of this swing and this is the low of this swing. So this is a swing and this is a swing. As I say, it simply means a move in price. So if we use this, we can see that this is a move that headed up and down. So we say that this is a swing to the upward direction, but this time around we'll call it a swing high because it is to the high region. All right, so we'll call this a swing high, and the same we get this swing headed down, we'll call it a swing low. So we'll have a swing high, and we'll have a swing low. So let's look at the break in market structure. So what is a break in market structure? A break in market structure simply means a break in swing points. So this is a swing, of course, a swing high. So this is a swing point. So if I draw a horizontal line at this swing point, we'll have something like this. So if this price starts going up again to break this particular horizontal line, we'll say that this is a break in swing point, and we'll call it a break in market structure. So this particular point here is a confirmation of this break in swing point. We'll call it the breaking point. All right, so this is a break in market structure, all right, because it is a swing point break. So the same thing is applicable if you have a swing low and this is a swing point. We draw a horizontal line at the swing point, and the next time market breaks that horizontal line, we'll say that is a break of a swing point. We'll term it a break in market structure. So this particular junction here is a proof that there is a break in this swing point. We'll call it a breaking point. So this is what we'll term break in market structure, break in market structure. So this is a break in market structure up, and this is a break in market structure down. So let's now dive deep into market trends. What are the types of market trends? So the market trends are divided into three. So at any point in time, the market is either going up, coming down, or is ranging. So because of that, we'll classify these market trends into three, which the first one is uptrend. The second one is a downtrend, while the third one is consolidation or ranging markets. So let's look at them one by one. Uptrend. What is an uptrend and how do I identify an uptrend? So we identify an uptrend by two ways. All right, so these are the things you see in the price charts and you say that the market is trending up. Number one is when the market is creating a higher high and higher lows. We say the market is in an uptrend. Then secondly, when market is breaking a structure, or when there is a break in market structure upward, we now say that the market is an uptrend. All right, let's represent this we just said with a picture. So you can see a market made a swing up, and we say that this is a high of this swing. If there is a swing down, we say that this is a low of this particular swing. So if there is another swing again, all right, you now see that it created another high, but this time around this high is higher than the previous high. We'll term it a higher high. All right, if market retraces again with another swing, we'll term it a low. But as you can see, this low is higher than this previous low. We'll call it a higher low. All right, the market creates another swing upward, creating another high. All right, also this high is higher than the previous highs. We'll call it higher highs. Market imprints another low that is higher than the previous low. We'll call it higher low. And the move continues, creating higher highs, higher lows, higher highs, higher lows, and higher highs. So when we encounter a market that is creating higher highs and higher lows, we say that the market is in an uptrend. So this is one of the ways you can identify an uptrend market. Another way we can identify an uptrend market is by the use of a break in market structure. So as I said earlier on, whenever you encounter a break in market structure up, we say that the market is in an uptrend. So you can say that this is a swing point or this is a swing high. So whenever market creates a swing high, then this point here is what we call a swing point. We can use a horizontal line or we can draw a horizontal line in this swing point. We have something like this. And anytime market is creating another high again, or the price is creating another high, breaking this horizontal line, we say there is a break in this swing point. All right, so this is a break in the swing point, and this is a confirmation that this swing point has been broken. So because of that, we term it a break in market structure here. All right, so if market retraces again, of course it has created another swing high. You can see it from here to here is another swing high. So we can still use a horizontal line and draw it at the swing point. And if price comes back again and breaks this particular swing point, we can say that this particular junction here is a proof that this swing point has been broken. We term it break in market structure. All right, so you can see markets breaking a structure up. And we say that whenever a market is breaking a structure upward, we say that the market is in an uptrend. So you can see market retraces again. We use a horizontal line, identify the swing point. Price comes back again and breaks the swing point. You say it's a confirmation of a break in market structure. This is it. And the move keep on creating a swing point. Then we'll break in market structure. All right, keep on creating a swing point. You can see another swing point. Use a horizontal line. All right, and when market comes back again and breaks that horizontal line, you say that here this junction is a proof that there is a swing point has been broken. We call it break in market structure. So this is a typical way you identify a market that is in an uptrend. When a market is breaking a structure upwards, we call it a break in market structure. All right, so in summary, I just stated that the two ways you can identify a market that is an uptrend is by the observation of markets creating higher highs and higher lows, and market breaking structures upward. All right, just as you can see in this diagram. So let's look at the price chart and explain the concept. You can see that the market made a high here and made a low. Then the next time market made another high. This time around, this high is higher than the previous one. We'll call it a higher high. All right, market created another low or retracement, made another high. All right, now when it created another low, you see that this low is higher than the previous low. We'll call it a higher low. The market imprinted another high. This time around, this high is higher than the previous high. You call it a higher high. Then created another low that is higher than the previous low. We call it a higher low. Then created another low that is higher than the previous low. We call it a higher low. Then created another high higher than the previous high. We call it a higher high. So whenever a market is imprinting higher highs and higher lows, we say that the market is in an uptrend. All right, so let's use the concept of breaking market structure in this same chart to explain it. You can now see that a market created a swing point high. All right, and we use a horizontal line to identify the swing point, and when price came back to that horizontal line, it broke it, and this place is a confirmation of a break in swing point. We'll term it break in market structure. Created another swing point. We use a horizontal line to draw on top of that swing point, and immediately price came back to that zone, it broke that horizontal line, which is a proof of a break in swing point. We'll call it break in market structure. Market imprinted another swing high. We use a horizontal line as usual, and when price came back again, it broke that horizontal line, which is a proof of a break in swing point. We call it break in market structure, and it continues going that way. So whenever we see a market creating a break in market structure upward, we'll term that the market is in an uptrend. All right, so these are the two features you can use to identify an uptrending market. It doesn't matter the kind of chart you are looking at, whether forex chart, crypto chart, indices chart, stock chart, and whatever chart you are looking at. Whenever you spot a market creating this structural break or imprinting higher highs and higher lows, you say that that market is in an uptrend. And let's look at a downtrend. So if you understood the uptrending market, then you won't have a problem understanding this downtrend, because it's just typically a reverse of the uptrend market. So we have two features we can use to identify a downtrending market, which number one is a market creating lower lows and lower highs. All right. So whenever we spot a market that is creating lower lows and lower highs, we say that the market is in a downtrend. And the second one is when the market is creating a break of structure downward. So when we encounter a break in market structure downward, we say that that market is in a downtrend. So let's look at it this way. If you have this a swing low, all right, we'll have this and we'll term this place a low, we'll term this retracement a high. You can see that the market just created a low and created a high. All right, so if market comes back again to create another low, this time around you can see that this low is lower than this previous low. We'll term it lower low. All right, you can see the market created another high here, but this time around this high is lower than the previous high. All right, we'll term it lower high. So if market imprinted another swing down, creating another low, you can see that this low also is lower than this previous one. We'll term it lower low. Created another high that is lower than the previous high. We'll term it lower high. So if markets keep on imprinting lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, we'll now say that this market is in a downtrend. So one of the features you identify a downtrending market is when market is imprinting lower lows and lower highs. All right, so this is one of the ways. So we look at the second way we can categorize or identify a downtrending market, which is the use of break in market structure. All right, we can now see that this is a swing point. All right, this is a swing low. I've explained what a swing low means. This is a swing low and this is a swing point. So we can draw a horizontal line at these swing points. All right, and whenever price comes back and break that horizontal line, we'll say that this place here is a proof that this swing point has broken. We'll now term it a break in market structure. All right, so you will now see that market created another swing. From here to here is another swing. So we still use a horizontal line to depict the swing point, and when price comes back again and breaks that horizontal line, we'll say is a proof of a break of swing point. We'll term it break in market structure. All right, we'll now say that whenever market is breaking structures down, we'll now say that that market is in a downtrend. So markets keep retracing, we'll still draw our horizontal line at the swing point. Price breaking the horizontal line, creating a break in market structure, retracing again, we draw a horizontal line at swing point. Price breaks it, a proof, we say break in market structure, retrace again, draw a horizontal line, price breaks it, we say that is a break in swing point, a proof, break in market structure. Then whenever we encounter a market that is breaking this structure downward, we now say that the market is in a downtrend. All right, so this is the second way you can identify a market that is trending down. So in summary, we stated that a downtrending market is when a market is creating lower lows and lower highs, and when market is creating break in structure downwards. These are just the ways you can identify a downtrending market. Now let's look at a downtrending market using a live chart. Now you can see market imprinted a low here, imprinted a high, then made another lower low, made another high, but this time around this high is lower than the previous one. We'll call it a lower high. Imprinted another low that is lower than the previous low. We'll call it a lower low. All right, you see market retrace again to imprint a high that is lower than the previous high. We'll call it lower high. So market moves down again to imprint a lower low. So when market is showing us this, lower lows and lower highs, we say that the market is in a downtrend. So the same thing is applicable. You can see market created a breaking structure here. So this is a swing point or a swing low. We use the horizontal line as normal and as usual. The market came back again and broke that horizontal line. We say that this breaking horizontal line is proof of a breaking swing point. So because of that, we term it breaking market structure. Market created another swing. We use the horizontal line. When markets are finished retracing, it came back again to break that horizontal line. We say that is a proof of break of swing points, and we term it break in market structure. Market moves again, creating another swing, then comes back again and breaks structures, and the move continues that way. So whenever you encounter a price chart that is breaking structures down this way, we'll now say that that market is in a downtrending market. Let's look at the last one, which is the consolidation. Now, consolidating market per se is not a type of trend. It's just the absence of an uptrend or a downtrend. Then you call it a consolidation. All right. So there are two ways you can still identify that this is a consolidating market. Which number one is when market is neither creating higher highs nor lower low. So the market is not creating a higher high. Market is not creating a lower low. So when we encounter this, we say that the market is consolidating. So the second one is when there is no clear break of market structure. So when there is no clear break of market structure presented, we say that the market is consolidating. Now let's explain consolidation or ranging markets with this. Now you can see a market makes a swing high. All right. Then after making a swing high, it retraced down to make another swing low. You can observe that it just created another swing low, all right, then created another swing high here. Now this time around, this new swing high created a high that was not able to take out the previous high, all right. It couldn't take out the previous high. So, and there is no clear break of market structure. So because of that, we'll say that there is no uptrend forming. So the market created another swing low. This time around, the swing low as well couldn't take out the previous swing low. So, and there is no obvious break of market structure that was created. So whenever you spot a market creating swing highs and swing lows, and if you draw a horizontal line to the top, it is not showing a clear break of market structure or a clear higher highs, then you can see that this market is just simply ranging. So if you draw a horizontal line below, you can still say that there is no clear break of market structure in this range and there is no clear lower low formed. So in the absence of any break in market structure either to the upward or downward direction, and in the absence of any higher highs nor lower lows created, you can confidently say that the market is ranging. All right, so that is it about this consolidation or ranging markets. Making use of trends to make money. We only identify the trends in order to take advantage of it and make money from the markets. We go long in an uptrend. So going long simply means to buy. All right, so our role as traders is to identify a market that is trending up and start looking for an opportunity to buy or go long in that particular market. So secondly, we go short in a downtrend. So as I said earlier on, your role as a trader is to identify a downtrending market and sell. All right, going short simply means to sell. So these are the two major reasons why we have to identify an uptrend or a downtrend. Now, obviously, you can ask, what about the consolidation? Now, there are a lot of things about consolidation. There are a lot of information that people pass about consolidation. You always hear buy at the support zone of a consolidating market or sell at a resistance zone of a consolidating market. Yes, you can do such and make money, but you have to understand that you have to be an experienced trader in order to trade that well. What do I mean? You need to understand the concept of liquidity. You get, so it's not just enough to start selling at double top or double bottom. You should bear in mind the concept of liquidity. So if you're a good trader, you can still develop a trading strategy that can enable you to buy at the support zone of a consolidating market or sell at a resistance zone of a consolidating market. But in general, we look forward to going long when we have an uptrend market, and we look forward to going short when we have a downtrend market. As I said earlier on, going long simply means to buy, while going short simply means to sell. So what are other ways we can use these trends to enhance our trading experience or career? Number one, we can use this trend identification in your favor in getting better entries and exits. All right, so if you understand how to identify a trend, you can easily get better entries and better exits in your various setups. Number two is low risk versus reward. Because market tends to move higher when it is in the direction of a trend, if you happen to understand how to identify the trend, you have a higher chance of entering a low risk trade and banging a high reward in that particular trade. So, and finally, building a good trading strategy. All right, so understanding the concept of trend will help you develop a good trading strategy. Now let's look at this chart. You can see in this chart, we bought this market here, or we went long in this market here. Our stop loss was here and our take profit was here. Take profit 1, obviously, because we will still expect this market to take out this high. Now if you observe, we were able to initiate our buy order here because market created a break of market structure here. This is a confirmation of this break, and because we understood the concept of trend, we know that after breaking a structure up, the market is now trending up, and we have to look for our entry at any point. So this entry was as a result of our trading strategy. But the most important thing is that the structure of the market that was broken helped us identify the trend, and because of that, we're able to initiate our buy here, risking 1 to make 3.5. okay, so this can only be done when you understand that the trend is the ultimate and you should always go with the trend. You can see this is our trading strategy we use to initiate this trade. You can see a market created a break of structure, which is the same as break of market structure. So immediately market created this break of structure, we actually knew that market will always retrace to this particular zone. So this is a terminal demand zone or order block. So whenever we encounter a break of structure, this strategy was built in a way that we wait for a return to the order block so that we can buy the market and anticipate the market to go up. So with the aid of trend, we're able to build this trading strategy. While with the aid of this trend, we were able to buy and have a smaller risk as compared to that of the reward. So these are the ways that trend identification can actually help you make money in the market. So in our subsequent videos, we'll be talking about how to build these strategies that will actually obey the trends. All right, so if you are new in this channel, endeavor to stay around, subscribe to this channel and click on the notification button so that you always be updated whenever we drop a new information. So if you have any questions, drop it in the comment section and we'll attend to that. Like and share these videos to your friends. Remember, we can all succeed together. We can all be financially free. PointFX is out to help traders succeed.